Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Emerging markets present the opportunity to invest in developing nations with fast-growing economies. In 2025, emerging markets have attracted significant investor interest, particularly in parts of Asia, Latin America, and emerging Europe, East Europe, basically. Chinese equities also have had a strong year, sort of through the last 9 months or so, driven by fiscal stimulus. There could still be more, and a recovery in some of the large cap tech stocks. So how will policy uncertainty, and this is a global story, and the geopolitical tensions that are enlivened and in there, impact the emerging markets trade? Will tariffs or the fluctuating US dollar play a part? We're happy to say that we are joined here today by institutional portfolio manager Abhijeet Singh to discuss all of this and more. Welcome, Abhi. Great to see you again. Great moment for this discussion as well. Hope you're well.
Happy to be here.
So the entire world is trying to grapple with what tariffs mean and whether they cost this amount, this amount, this amount, the range. Everyone's trying to figure it out. Are you any better at that than anyone else?
I wish I was, but it is a moving target for sure, and has created a lot of excitement, chatter in the market volatility, and we're kind of dealing with that on a day-to-day basis. Obviously, one of the things that we have learned over the years is not to react too aggressively to any news, especially when it's macro-oriented or geopolitical news, and we have kind of stayed the course with minor adjustments to the portfolio. But it is a period of uncertainty, a period of, I would say, market digesting news and reacting to news. So we're trying to focus on the fundamentals and be a little bit more, I guess, longer term oriented in our investments.
I mean, the style of the fund, the way you and Sam run it, it's GARP. It's you're not buying expensive stocks typically in areas that may have stock markets that are, not just stocks, but also the entire indice is sort of bid up a bit. I mean, I'm thinking of India right now, which is a really interesting place, obviously, to be invested in. It's become very expensive. I wonder if we just begin there. We're going to go a little bit around the world, the universe of where you invest. But money has left North America and has gone other places. It's gone to Europe, it's gone to other places. Tell us a little bit about the story of investing in India through the last year and looking ahead.
Yeah. So India has been a net beneficiary of troubles that Chinese equities have faced over the last several years, and the market has really been bid up. And I think Sam, essentially being concerned about valuations there, is almost at max underweight. What we are allowed to do in our fund, about 10% underweight. And that has not changed even through the volatile period that we have stayed in. India started underperforming China, and kind of the basic data trade started reversing in the third quarter of last year, and went through that phase till the Liberation Day, where even year to date, China was outperforming India, and it was working the way we wanted it to work, and Q1 returns show that. But after that announcement, obviously, some of that has reversed because Indian economy, Indian stocks in general are less exposed to exports and hence less exposed to the tariff back and forth. And that meant it became, again, a safe haven in the near term. So we have kept our underweight position because we still feel that the valuations are quite stretched. And it's harder to find positions that might make sense from a fundamental basis in India at this time.
Okay, interesting. Anywhere else in EM, in emerging markets, that is overpriced? I mean, there's discussions, again, with sort of an international switch and trade and interest suddenly that, some parts of Europe are even over extended in terms of valuations. That's not where you're looking. But are there parts of EM that actually are overdone, do you think, apart from India?
I think, again, going back to middle of last year, we started trimming a little bit of our AI-related exposure, whether it's semiconductor companies or TSMC or other players that kind of participate in that supply chain, mostly worried about, everything related to AI was just kind of going through the roof. And we didn't want to be there because we felt these tech names in Taiwan in particular became very expensive. So Taiwan is another place where we have a significant underweight at a country level, but it's all coming up from the bottom up, right? Not moving from an overweight position in TSMC to start the last year, and then moving over to more of an underweight towards the middle of last year, was all part of that adjusting the portfolio and reacting to how the markets had moved.
So that's really interesting because you said the end of last year, so 2024, which is before. It doesn't mean that DeepSeek didn't exist before that, but the moment recognized it, the markets recognized it in January, and it was a moment, as we well know. I wonder if you could just spread out that moment and what it meant for the U.S. trade of big tech. It was definitely a moment, and then sort of the ripple effects ultimately to where you are investing.
Yeah. I mean, it all kind of goes back to actually trade and back and forth around access to the NVIDIA chips for Chinese companies. So for a number of years, Chinese tech companies were not really investing in AI and kind of on a back burner for companies like Tencent, etc. And that changed. I think that's where the most meaningful impact happened from a DeepSeek perspective, is that there was a proof case that you can do quite a bit without having like the latest and greatest chips. It did create some sell-off and turmoil in the early days in the US markets. We saw NVIDIA kind of really roll back. Concerns were like CapEx announcements by the big players like Google, Meta, etc. will disappear or become much smaller. That has not been the case. I think a lot of the companies have reiterated that they're going to continue to build the data centers and continue to invest at least for a foreseeable future. So NVIDIA has bounced back, as we all know, is back to where it was or higher. It's going to announce its earnings today, so I'm not sure like what's going to come out of the earnings call. But in general, things bounce back.
It's hours away. It's hours away. It's a wrong moment to be asking you this. So, but in any case, yes.
But I would say that the DeepSeek impact was more on Tencent, Alibaba, other tech companies in China that have ramped up. We're going to invest more in AI because we think we can do a lot more than we thought we could with not having the latest and greatest chips.
So
that was the main thing.
It was an amazing, stunning. It was sort of, the markets were a bit stunned, weren't they? It took almost a day really for it to properly kick in terms of the market digestion of that moment. I've been wanting to ask you about that for months now. Let's talk a little bit about China. In the fall, there was some stimulus that came through from the government. We've been waiting. I don't know. The investment world seems to expect more stimulus from China because of the real estate sector and other reasons. And it got some of that, and things got bid up incredibly through the fall. Did you catch that?
Yeah, we have been overweight China for some time because, again, our growth at a reasonable price kind of framework leans us in that direction where we saw a lot of value emerging and a lot of good companies that were still growing their earnings were really, trading at like all-time low multiples. So we were overweight China coming into the end of Q3, which is when the initial stimulus announcements were made, and we participated in that upside. And obviously, DeepSeek also created kind of a turmoil within China, and we were overweight Tencent and some players, but not necessarily participating in some of the other parts of the market. But in general, we've been able to navigate this environment pretty well. One thing that we've changed a little bit on the margin is take some bets off, or maybe reduce our overweight in China in the aftermath of the tariff announcements and back and forth that's been going on since. Mostly because to deal with this uncertainty in the near term, because while there is a break right now in terms of where the tariffs have landed for now, and they're negotiating, but we don't know where this ends and how long it'll take for equilibrium to emerge from a trade perspective. So under slightly smaller overweight in China was warranted in this type of uncertain environment.
Since on April 2nd, we saw that astonishing board of tariffs. In any case, Vietnam got hit pretty massively. I mean, it was outrageous, which of course was sort of the idea that China is hiding manufacturing in other countries. This was more related to Trump 1.0 when China was hit with tariffs, and this was kind of the reaction. It's actually years old in some ways. But that said, it kind of makes you wonder if some of the countries that are neighbors to China, where China did move manufacturing of certain things to work around the tariff situation then, what will they be forced to have those manufacturing leave their countries? I mean, what does it leave a country like Vietnam, but others as well, with? And again, how do you look at that from an investment perspective?
Yeah, well, Vietnam is not really in our universe yet, but your point is valid. It's valid for a lot of other countries, including LATAM in Mexico, for example, where after the initial, the previous Trump administration, there was a lot of talk about everybody needs to, especially after COVID, everybody needs to have a China plus one type of strategy, that you need to diversify your supply chains and make sure you're not dependent to one geography to kind of do all the manufacturing for your products. And Apple, for example, well-known example, has diversified into India to do a lot of the final assembly and distribution of iPhones, and that's again has grown quite a bit. But there's a limit to how much can be built in India because infrastructure kind of constrains that a little bit in terms of what can be made and what can be shipped out of there. So there's that aspect of it. I think again it's an uncharted territory. We don't know where the equilibrium is going to be at the end, especially for some of these more smaller trading partners like Vietnam, for example, and because net there's very limited ability for US to sell anything to these countries, smaller countries,
right, to even it out.
From a point. But so there's no way around it, right? So it can become a balanced trade between a US on one side and Vietnam or Bangladesh or some other places on the other side. So there will be turmoil in the near term, but I think we all knew that the main objective is to kind of reach some sort of a balance with China. Everything else is more secondary and I say collateral damage, unfortunately, wrong word to use, but it has been like that.
Yeah. Well, Mexico brings us all to sort of an interesting point because also from a Canadian perspective, we're wondering what a renegotiation of the USMCA, CUSMA, NAFTA, lots of different names for it, will look like. And we actually don't really know if it's going to be bilateral relationships with the US or if it is indeed going to be the entire US. How do you invest that, assuming that Mexico somehow is going to be okay because it's right next door to the US? Or, I mean, is that the right assumption?
At least that's where Sam stands today. So our assumption is that Mexico market has a lot of bad news priced in. There was concerns after their own election where the peso kind of depreciated pretty aggressively right after that. And then obviously the US election, then the trade and all that stuff. So a lot of bad news is priced in. But having the proximity to the US economy, both US, Mexico, and Canada kind of pretty intertwined, as we've seen over the last few months around how manufacturing of cars happens and how things go from one country to the other, and then ends up in the end market. It's a little bit complicated. So it's very hard to see that would change. I think the big issue with Mexico is, as I was saying, around Vietnam as well, like a lot of the capex that, not all of it, but a good amount of capex that was put in northern Mexico for manufacturing capacity was, again, an extension of Chinese companies trying to, avoid benefit from USMCA and avoid tariffs and things like that. So I think, again, that would be something that might be part of the renegotiation. I don't know for sure, but I would think that's a pain point that the US government wants to deal with. But in the end, I would say, if you believe our positioning today, we're quite overweight Mexico, quite overweight Brazil as well, and underweight, again, India is the biggest underweight, and Taiwan. So I think we are in the camp that Mexico is going to be fine. Is
Brazil a domestic story? Domestic consumer market story, or is it an exporting story for you? What kind of companies do you like in Brazil?
Yeah, so Brazil exposure is kind of a mixed. I mean, there's obviously some natural resources that we are exposed to there in terms of oil and gas company, some mining exposure there as well, but then some consumption stories as well, like Localiza, which is a rental car company. So the big issue there has been, and I think we probably talked in the past, is that we were expecting like last year to be the period when interest rates are going to really come down in Brazil, and they're going to come down a lot because the real rates were very high. But middle of last year, there was a U-turn done by the central bank because inflation picked up for various reasons, including some fiscal policy that was a little bit more, I would say, on the higher spending side from the government.
Because they had been lowering rates for a bit there from like 9%, but then they went back. They weren't
went
finished.
back up. And now I think we're at a point that they're going to come back down. So that oftentimes is a tailwind. Brazilian market is already reacting to it. It's, I think, one of the top performing markets for the year in EM space. Mm-hmm. So it's already there and we're positioned for that. So I think that would be a good tailwind for the performance of the portfolio.
So let me ask you a little bit about PEACE, as in PEACE, and the opportunities to, I mean, aside from, would be great for a lot of people, clearly, the investment opportunities in Eastern Europe due to a discussion, at least, of Ukraine-Russian peace in the Middle East as well. Syria is now not in a civil war and has new leadership. Again, we're not sure. How do you dip your toe in, get ready for that? Because, of course, if there is a deal signed, that's the kind of thing that flies. Do you go there yet?
Indirectly.
Okay.
Directly, we're not allowed. So we have exposure in Eastern Europe. So banking exposure in Hungary, in Poland, in Greece. These are all companies are obviously there's good standalone stories based on what's happening in their local market, but they are in the neighborhood, and some of them have some connections to Russian banks and things like that. That they would be as you mentioned, if there's a deal to be had and there's a rebuilding effort, these companies are going to be right there to benefit from that. We also built a position in a industrial company out of Turkey that makes transformers and things like that. And that would obviously be also part of the rebuild in that region. All the different things that you mentioned around Gaza, as well as Syria and Russia, Ukraine. So net, there will be opportunity for these companies that are closer to participate in that upside. So we have, I would say that's not the bulk of the thesis behind these names, but it is a call option, right? So if things do go in that direction, then these positions are going to really add a lot more value, but nonetheless, they're doing well.
Is what we think of as the Middle East, which is a region of many different economies, the Gulf, is the Gulf still EM? I mean, at what point do they get given your banking system is beyond that?
The Gulf countries are still EM, and I think Saudi Arabia is still a big chunk of emerging markets benchmark. For example, today it's about 3.5% of the benchmark. It was a little bit higher 6 months, 12 months ago. We have some exposure there, but it's limited. Right? And it's expensive. It's hard. A lot of the economies are trying to diversify away from oil. It's easier said than done, but there is expectation, especially in Saudi Arabia, as they put in a lot more infrastructure investment in place, that they are going to continue to diversify and potentially, the stock market gets more liquidity, and there could be emerging opportunities in the longer term. For us to keep looking at that space. Sam only has one position in Middle East, which has been there for a while. I would put that in the bucket of having something. So it's a little bit more of a risk management type of position. Okay. But that could change as more and more companies go public and there's more liquidity there.
What do you think this year, 2025? I mean, you have to look beyond that, but it's been a turning point for investors' appetite for international stocks. We're sitting on the cusp of the second half of the year, just a couple days away. What do you think this year has shaped up to be thus far? And going forward, the EM trade, I mean, for what you can see, and I understand that everything is uncertain, but it's been a pretty good year so far.
Yeah, I think EM has a lot of different ways to win in the next few quarters or maybe multiple years. Obviously, the valuation framework is still valid, still very inexpensive compared to the US markets and developed markets. Yeah, EM, I think in a scenario where you see the US slow down a little bit and the Federal Reserve actually kind of tilting and doing more rate cuts, that could be net positive as well, because you're going to have central banks in EM across the board looking for ways to, again, cut rates and stimulate their economies. I think, obviously, if there's a deep recession in the US, then it becomes very hard to hide anywhere.
Right.
But if the base case is like a slowdown or a mild recession, that would be a good kind of a situation for emerging market equities. And I guess that like having that tailwind of rates, tailwind of valuations is going to be positive. It's been working. A weaker dollar also is enabling that. I think, and again, that's those all come together as a potential for EM to continue to work as it has year to date.
Really interesting. So you can trade and do well through this type of uncertainty, because EM traditionally does have actually an awful lot of uncertainty and is often linked to government policy, well, in certain countries anyway, and you have to follow that very carefully. I'm just wondering, as not really an investment question, but do you just find there's a similarity that all countries, if you're looking at them as countries, are following the policies a little more like you follow an EM policy in a government? Is that fair? Is that an observation at all?
Sure. I mean, it is a little bit tricky. I think like everybody is looking at geopolitical risk kind of comes and goes over time. I think right now we're at a point where it's quite high from a different, whether you're looking to invest in the US or in Europe or in Japan or emerging markets, you have to take into consideration what happens on the geopolitical side and what the government policy is or what the intent of the government policy is. So I think that's embedded into all the discussions we're having on our platform, right? So there's no way to hide by not having a view. You have to have some view, some expectation around these top-down topics as you build and manage the portfolio.
If we go back to China for a minute, you mentioned the overrate is coming down a little bit. It's been a very interesting sort of 9 months or so. The stimulus question is there. How goes there's a demographic story in China, but there's also the continuing development of the capital markets, and I guess investing away from real estate. Is that still unfolding? I mean, you would think because it's been such a glut for the real estate market that would have happened pretty quickly, but some changes take longer. Bring us up to date on how the government is trying to divert investors away from real estate and into other types of things, presumably the stock markets.
Well, real estate, as you said, has been a big headwind, and it's obviously pushed away anybody who wants to buy another property in China, and that it's excess capacity that's built into the system, and it's taking a long time for it to kind of unwind. In the meantime, I think around COVID, post-COVID, there were a lot of like regulatory pressures that were put on a lot of different types of companies that made the domestic investor not trusting what's going to happen, and that's led to a pretty sizable amount of money just sitting in banks in terms of savings. And I think as the sentiment, which again has been hurt a little bit by the trade war, as the sentiment improves, you will see like the investors kind of come back to the market. I would say net institutional international investors are back in China in terms of flows, and I think even if you look at the traffic at China's specific conferences, so the interest is back. from an external perspective, I think the internal investors are probably going to be more, as in the past, more momentum oriented, more seeking returns and chasing returns, and also becoming more confident that the government is not going to be putting roadblocks from a regulatory perspective. And as that happens, I think things will kind of turn in the other direction. But obviously, right now, a lot of it is around the trade war. A lot of it is around like how to reach some sort of an equilibrium in the relationship here. I think as we get closer to like more of a resolution, you could see that unleashing more investments from domestic investors.
Interesting.
What is unlikely to happen is like unlimited or a huge amount of stimulus. It's going to continue to be the way it has been, which is targeted, trying to solve problems, trying to give more incentives in certain areas.
Like what? What areas? Sorry to interrupt you, but is it to try and push people into the stock markets, for instance? Like what type of sweeteners are on offer within the stimulus?
Yeah, I'm a little bit more consumption-oriented sweeteners domestic around economy. This home improvement, maybe buying a car, things like that. So you've seen a lot of these EV companies in China that have done really well. Even companies like Xiaomi, that's mostly a phone company, launched in one EV, and then suddenly the market just awarded it by a lot. And that was something we didn't have in the fund, but that created a headwind. But nonetheless, I think there is appetite, and there's a lot of money sitting on the sidelines. And as confidence and good news kind of comes back into the market, you're going to see that money go to work.
Okay, so as a Canadian investor taking a look at diversification, we're already in Canadian bucks, so we're already looking at different ways. Why EM over perhaps IFA or developed international investment?
Yeah. You got to have both. I would say you got to have both, right? So you need to have, Europe is kind of interesting right now because I think there's a good amount of expectations built that there'll be a huge amount of industrialized, defense spending, and that driving a lot more of, economic activity in Europe. And you've seen some companies in Germany and France do very well in that regard. Emerging markets still represents a kind of a growing part of the world, growing by population, growing by economic strength and spending power. I think all the different countries that we're talking about today are at different stages of growth and development. So the investment opportunities obviously vary by where a particular country might be in that cycle. China obviously is a lot more mature from a cycle perspective. Same for Korea, but then the places like India and Eastern Europe, with all the wars that have been going on in that part of the world, there's going to be a lot of demand for infrastructure and things like that. So it just varies by different parts. Best thing to do is to remain diversified. As we've seen, the U.S. market can have pretty sizable hiccups along the way. So that's when you feel good about having a diversified portfolio. You don't feel good when it goes up in one straight line and everything else kind of falls behind. So maybe we're out of that phase, and you're going to see more contribution from other parts of the world in the global equity markets
in the months ahead. Abhijeet Singh, thank you for joining us. Great to see you. Thank you for catching us up on how you're invested across the emerging markets.
Okay, thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.